Hello and welcome to the Weekend Investing Daily Byte of 10th of September. A better day. Markets opened almost gap up and stayed higher than yesterday. So the downtrend that was witnessed in the last few sessions at least bucked for the day today, and markets looked reasonably stable going forward. Uh, in today's video, we will discuss if markets can deliver 0% returns in 15 years. We'll look at some history of other markets. And are we just getting carried away in exuberance that markets can never fall? Let's learn from history. Let's be, aware about how markets can play, how our expectations should be built, and how we should be preparing for the worst. But this towards the end of the video. First, please go ahead and subscribe to the channel if you haven't so far. Where are the markets headed? The market had a very nice jump, I would say, 0.42%, did not really close near the highs of the day. So it did give back some of the gains, but nevertheless, a decent jump after the fall in the last 4 or 5 days. This is pretty much a very consolidating, stable kind of market, not really in a rush to go either way. Maybe the market is waiting for the interest rate cut situation that will happen next week. Nifty Junior slightly up 0.2%. Again, I mean, nothing really much to talk about. Consolidating near the highs is not bad. Mid caps, in fact, made a very nice, uh, you know, candle pattern here. And with a gap up, it has closed very near the previous highs, up nearly 1%. So very sharp move from this bottom to the top today in just 2 sessions. So mid caps are looking actually much stronger, and small caps have also taken a U-turn from the previous highs, 1.25% up for the day. So again, very close to the all-time high. So nothing wrong in mid caps and small caps as an index, but within these uh, uh, indices, you are seeing great churn happening. So a lot of PSU banks, public sector enterprise stocks, defense stocks are softening, and other sectors are coming forth like consumption, pharma, etc. And we'll talk about that. Bank Nifty marginally up 0.3%. Can't complain, above the average now, and looks quite stable going forward. Can really take a nice jump if there is some hint of interest rates cut in India also. So yields in US as well as India are dropping much faster ahead of the interest rate potential cut. Uh, Even in India, the yields have dropped by more than 0.5% on the 10-year bonds, and expectation is that the rates will get cut. Let's see how our RBI will act. Uh, uh, Fed is likely to cut 70% probability of 0.25% cut. Half a percent cut is about 20 odd percent, and rest is maybe unchanged. Um, Advance versus declines. So this is CNX 500. So you had 382 advances, 214 declines. So largely the market was focused towards advances, and you had significant advances in 0 to 5% range. Of course, there were some which really ran away also. And versus last 2 days, FIIs on 9 September bought 1176 crores. DIIs also bought 1757 crores. So the buying seems to be back. The data for equity part also is suggesting that more money, the highest amount of SIP has now gotten created. I think some 23,000 crores, if my figure is not wrong. And debt inflows have reduced. So overall figure that has been released is much lower than last month, but on the equity front, it is higher than last month. So from that perspective, there is no damage on the equity front. Heat map for Nifty, you can see IT stocks really doing well. Energy and power stocks did well. Bharti Airtel was doing well. Uh, Life insurance companies, HDFC Life, SBI Life were knocked down very badly after there was no decision to remove GST in the GST Council meet, and the only relief was on namkeens and not even on life-saving drugs. So I don't know what that logic is, but nevertheless, Pharma Divi's Lab was racing today 4.9%, and you also had some gains in Maruti, Titan, Cipla, NTPC, Power Grid, LTIM, etc. In terms of Nifty Next 50, you had some nice gains in Geo Finance, Tata Power, Zomato, Jindal Steel, Havells, uh, some gains in BEL. But this public sector, finance sector is losing ground rapidly. REC, PFC, they are losing ground. Vedanta also losing a lot of ground today, 4.4%. And ICICI Pruli, as per the previous uh, GST thing, down 1.6%. Sectoral trends, IT leading the pack, 1.7%. So it's like a rebound day, 1.7 on IT, 1.1 on pharma. So this is somewhat showing that the market mix is rotating into more defensives than risk on assets. So while FMCG did not do well today, FMCG did well yesterday, but the gains on green days are seeming to be in IT, pharma, FMCG, and sometimes in consumption. Today, of course, infra, reality, and energy also rebounded back from their falls. But if I were to see on a weekly basis, FMCG is still ruling at the highest gains for the last 1 week, followed by consumption stocks, pharma stocks, and IT stocks. So there is propensity to go into hide into defensive stocks rather than go into high risk stocks, and that may be signaling that upsides may be capped to some extent, and the sector rotation is on. So IT stocks, Coforge, LTI, Mindtree, Emphasis, Wipro, L&T Tech, Persistent, all gaining more than 2%, and TCS, Infosys also gaining some ground. IT as a whole very much near the previous all-time highs, looking good. IT index, you can see here, after a very long sort of consolidation and sort of a inverse, sort of a cup and handle also. So there could be a reasonably long way to go from here in IT, and IT has really done well given the fact that IT index was near 10,000 at the bottom of the COVID, and now we are sitting at 42,000 within 4 years. Stock spotlight is on Prism Johnson, up 19.6% today. So after a long consolidation of 8 or 9 months, this stock is running very, very hard. And uh, the Prism Johnson chart, long-term chart, shows how choppy this stock has been. 60, 80%, 84% drawdown, and of course, those who held through these drawdowns have been rewarded quite well. Can the markets deliver 0% in 15 years? That is the question we are asking. There is no suggestion that the next 15 years are going to be 0% returns. Um, but has there been history of any market delivering 0% in 15 years? Yes. Has there been history of markets returning 0% in 10 years? Yes. 5 years? Definitely yes. So you can't rule out the fact that markets may have no returns for next many years. It may start tomorrow, it may start in 2 years, nobody knows. But that potential cannot be ruled out. And the only way really to navigate that is to not sit in the index, but to sit in a strategy which can, actively try to gain strength out of the index. So let's now see the India movement, market movement since the last 30, 35 years. Uh, if I draw this channel, it is seemingly, continuous path upward. So 2047, whatever are the targets look like, we should be able to reach there. Nifty in 2047, even if we are in the middle of this channel, will be somewhere close to 2 lakh basis this path. So maybe about nearly eight times is where we can reach in the next 20 years if we go this path. But there have been, all kinds of markets sometimes having these assumptions that markets will continue to go like this, SIPs will continue to come, there will always be liquidity despite very high valuation, stocks will continue to deliver. So that once that continues to happen for 1, 2, 3, 4, 5 years, one can sort of fall into that trap of assuming that it will always happen like that, but it need not happen like that. For instance, this chart from Free Fincal I'm referring to, uh, so they've calculated 15-year of SIP in S&P 500, and there are 1000 15-year periods. Each month you take a 15-year XIRR in the last 115 years. This data is from 1900 till 2015. Um, so it shows, of course, there were more such periods in the World War, Great Depression, World War II, and also, when Vietnam War was there, Gulf crisis was there, and of course, Lehman crisis was there. There were periods, there were months where XIR returns of 15-year SIP was zero. And of course, over a period of time, that recovered. So the maximum 15-year SIP XIRR on S&P 500 has reached 16%, and the minimum has virtually been at zero. So there can be periods of, if not zero, 0 to 2% for long periods of time as per history. And if we don't go that far, then maybe we can look at China Blue Chip 100 Index, which is now very near 6 or 7 year lows. And if the way this pattern is, a head and shoulders pattern is making, maybe we will go to a 10-year low very, very soon. So, I mean, there is history that, markets can become overheated and then may take a very long time to go from that overheated to over or under owned, undervalued point. So that pendulum can swing very, very long, just like in Japan also. For 20 years, Japanese market was racing. It went up like 40x, and then it collapsed for the next 20 years. So you cannot say that the markets cannot, go flat for 5 years, 10 years, 15 years. But yes, there will be a ferocious run before that happens. That is very, very likely. And I don't think we are in that ferocious run, at least not as yet. Maybe few years if we just continue unbridled 20, 30, 40% kind of gains every year for several years, then then there's a case for a very long term uh, flattening out of the market. So technically, even a 15-year SIP can yield no returns, although I don't want to scare SIP investors. But the importance of strategy over duration also cannot be ruled out. So just having a index strategy that I'm investing in index and hence, I should get a 12% return may or may not happen. That cannot be your best and worst case. It may be one of your cases, but then you also need to have plan B. And plan B could be to have more duration. Plan B could be to have more asset allocation. US finance experts are stressing diversifying globally to mitigate risk because they are seeing that maybe the US markets have plateaued and the global power that US has been in the last 100 years may not be so in the next 20 years, for instance. So there is chance that diversification may help. Uh, in India's context, blindly betting on India's growth story without a proper strategy can be risky. Let's say you're blindly betting on Nifty, um, and we have all kinds of maybe a joker government comes in worse than, let's say, the current one. Uh, what happens then? Maybe there is war on some fronts. I mean, we are surrounded by virtually bankrupt countries, whether it is Sri Lanka, Bangladesh, Nepal, uh, Pakistan, and of course a deterrent of a neighbor in China. So geopolitically, or politically inside the country, or any kind of internal civil unrest, anything can happen in any country. So while everything looks good and hopefully should be that way, there is no certainty that that has to deliver at end of 10 years or 20 years. So asset allocation especially is very important. I can never sort of stop talking about asset allocation because I think risk is something that we don't uh, you know appreciate until it is there at our doorstep. So the best way to protect yourself is to forecast and foresee what could be the risk to your portfolio. If my 100 rupees of my assets are all in INR, then is INR a black swan event waiting for me to happen? If all my money is in equity, is the equity market a black swan waiting for me to happen? Uh, so that kind of a scenario building. What if this happens? Where will I get any relief from? These are the things that you have to think about instead of just thinking that where can I maximize my returns. So uh, you know uh, performance but with safety, Just like in a car, you just can't look at a car just because it goes fast. What about safety, right? I mean, you also look at safety. Why do you look at a car where it has great safety features also? Because you know that it may never happen to you, but just in case it does, you know, will that extra performance help matter at that point of time? So diversifying assets ensures stability, preserves gains when markets become unpredictable. Buy and hold, of course, is the mantra for folks. But I can tell you, when steep drawdowns happen, maybe like 2008, maybe like 2020, or maybe like 2018 small cap crisis, when 60, 70, 80% kind of falls happen, all kind of conviction goes out of the window. And hence, not allowing your portfolio to go down that deep is a very good option, even if your end result is maybe a few percentage lower than your neighbors. So regularly rebalancing your portfolio, getting rid of your losers early, and holding fast onto your winners. I think that is very, very essential for a very healthy mental sort of positive approach to the market. I mean, if I am, my stocks are bleeding and it is giving me a sleepless night, and I'm lethargic and I'm feeling depressed that I've invested all my money in equity and now I'm down 60%. I don't know what my future is. Why would we want to subject yourself to that? Let the journey also be enjoyable, let the journey be positive, and even if we make a little less money, let's have a great sort of outcome out of the investing journey that we look forward to. So what do you think about all these aspects? Do write in the comments. Love to read your comments. Do give us more ideas what we should discuss here. Are you liking this channel? And your feedback is always welcome. Thank you so much. Please do like and share this video. Thanks. Bye.